In a week that's been dominated by US inflation, with both CPI and PPI coming in hotter than expected, we come into a new week that's going to see a continued focus on inflation about other parts of the world, but also central bank decisions with the likes of the RBA and the RBNZ both reporting their latest monetary policy decisions. So plenty to get into, but a focus a little bit further away from the US for the week ahead. So let's get into it. First and foremost, this is a list of the big ticket items according to Trading Economics for the week ahead. And you can see things really kickstart overnight on Tuesday, sort of Monday going into Tuesday, with the RBA interest rate decision. Interestingly enough, we have an expectation of a rate cut, the first rate cut in the cycle for the RBA. And there's been a perception that they've been behind the curve. But bear in mind that the RBA already started with interest rates that were significantly below many of its peers. And also some of the other central banks, whilst they have cut, the likes of the Federal Reserve and the Bank of England, it's been a slower pace than we thought would be the case at the inception of that easing process. Some areas, not necessarily the case, the likes of Canada, the likes of the Eurozone. So elsewhere on Tuesday, we've got the unemployment rate coming out of the UK. That's part of the jobs report in a week that's going to see a focus on the UK. ZEW economic sentiment, inflation from Canada, RBNZ interest rate decision on Wednesday, UK inflation, so continuing the UK theme, then the Fed minutes on Wednesday, Australian unemployment, so the jobs report out of Australia on Thursday, continuing that Australian theme, inflation out of Japan, and then wrapping up the week with yet more UK data with retail sales, and then a raft of PMI numbers coming out of Europe and the US in particular, but essentially globally for us to wrap up the week. So first and foremost, let's look at the UK. So a massive week for the UK, with Tuesday bringing the jobs report, Wednesday bringing the inflation report, and then Friday seeing the retail sales numbers and the PMI figures. So all to play for. I guess the fear here is that there's a perception that the UK might be struggling with inflation in the same way as the US. And the US has now moved to a point where June was going to be the first rate cut, then July, now it's September. It feels like we're moving in the direction where we might not see a rate cut at all. And it really comes down to how the data comes out. We haven't necessarily seen the implications and repercussions of a Donald Trump presidency quite yet. Yes, the CPI numbers for the week just gone are relevant because that's when he came into power. But of course, he hadn't enacted any of his policies. And if he does bring out some highly restrictive tariffs and stick to those guns and maintain them, then that could be highly inflationary in nature. Nonetheless, I digress because it's all about the UK. And the UK's question mark here is, what's the economy looking like at the moment? We did see a better than expected GDP reading, but at 0.1, it's nothing to get too excited about. And then inflation, there's an expectation we see headline inflation moving down to 2.4 and core moving down to 3.1. So this is a really important inflation report if we're potentially going to see downside moves across the board. Will that embolden people to think that they should be investing in the FTSE 100? Is that going to be the kind of thing that will see the pound weaken? Certainly, these are the kind of things you're going to be thinking about. In terms of the inflation, you can see here we've got the core and the headline inflation 3.2 and 2.5. What's interesting in particular about this reading is that it is the January figure. And January generally sees significant negative readings come out every single year. So you can see the minus 0.6 figure for the headline from last January in the left-hand side of the middle section. And then minus 0.9 is being replaced from the core. And so you might look at that and think, God, we can see a huge jump in terms of inflation if we don't manage to match these. But if you look back historically, every January we see figures like this essentially. And the expectation this time around is that we will see a minus 0.9 on the headline and minus 1% on the core. So markets are expecting to see a similar kind of negative reading across both of these metrics. And if you look at the sort of trajectory of where we might be by the end of the first half of the year, you can see the 7-month annualized, which essentially I'm looking at sort of where are the sort of big figures, and I would say February, March, April, May. So when we strip those out, where are we going to be? Well, for the core, we're currently tracking at 2.58. For the headline, 2.1. Currently at 3.2 and 2.5. So we are heading in the right direction in the UK. That means that the Bank of England should feel emboldened to be able to take action where necessary. What's the expectation this time around? So March, expectation of no rate cut. So just a 19% chance of a rate cut. Then a rate cut expected 25 basis points, 70% chance for May. And then if you look throughout towards the sort of back end of the year, you're only really looking at another sort of maybe one more rate cut on top of that. So 50 basis points worth of cuts for the rest of the year from the Bank of England expected. Are we going to see a change to that? Well, certainly this inflation report has the possibility to do that. Now, what we have seen of late in terms of tariffs has been a sort of shift away from some of the concerns that had been very prominent. And the fact that they've delayed the tariffs for the likes of Canada, the likes of Mexico. He's talked about 10% tariffs on China, but actually I don't really want to impose them. I'll speak to Xi Jinping, things like that. You know, certainly I would say that he's taking a softer approach to tariffs than many had thought. That being said, the reciprocal tariffs, where he's essentially going to be impacting any country that puts tariffs on the US and trying to match it up, that, of course, is a concern. But we also have the fact that that has been delayed. Nonetheless, the UK stands in a very strong position because the UK does not hold a trade surplus with the US in terms of goods. And therefore, the UK stands in a position to have a good trading relationship with the US at a time when people are fearful of what might happen in terms of tariffs to businesses in the regions that they're looking at. So that benefits the likes of the FTSE 100 as a potential investment case. Let's look at the FTSE, and you can see exactly how that's been playing out. This is the daily time frame. You can see that we've been pushing higher and higher and higher. The monthly time frame shows you we've broken out through into record high territory. So this has come into favor of late. Certainly if we're looking at, say, the FTSE against, so let's go UKX, against, let's say, the SPX, right? So S&P 500 on a new scale. You can see here, the FTSE has been outperforming its US counterpart over the last month, right? So is that something that's going to be long lasting? Well, let's look at the monthly time frame. This is the long-standing trend. The long-standing trend is for US outperformance. But right now we're seeing UK outperformance, in part because there's fears around inflation in the US and what that might mean in terms of the ability to cut interest rates. And there's also fears of overvaluation in terms of the tech space. Of course, we heard about the DeepSeek breakthrough over in China. So the possibility that AI isn't necessarily a monopoly that the US is going to hold is a concern for people investing in US markets. And that has pushed people towards other indices, other assets. And the UK is positioned perfectly for that, in no small part because of the fact that the UK doesn't look like it's in line to be hit by tariffs. And so people that are worried about tariffs can look at the UK's FTSE 100, FTSE 250 and say, that might be the kind of place that I want to put my money. So what have we seen here? We've seen a pullback coming into play the second half of the week just gone, or that's closing out. But set within a wider trend, this looks like a likely retracement. We've come into this deep fib retracement zone, so we'd need to see a breakthrough 86.84 to point towards a wider pullback coming into play for the FTSE 100. Until that happens, you know, you're looking at a bullish trend that still remains in play. Now, this daily time frame also highlights the fact that even if we were to break through that, the wider trend, the more evident trend on this daily time frame would really point towards this wider retracement being more relevant. That does mean we could see a deeper pullback if we saw a break through that swing low that we're highlighting on the 4-hour chart. But ultimately, it points towards the high likeliness that, you know, we see a few days of downside. You've seen it. So 2 days, then rally, 3 days, rally, 1, 2 days, 3 days. So we're into our second day. Yes, we could see a little bit more weakness over the near term. I don't think it's going to be long lasting. I think the FTSE 100 is well positioned. And certainly if we do see the inflation numbers coming in relatively weak and we see headline and core inflation moving towards the downside as markets expect, it provides the basis for continued confidence in this market. Next up, let's look at the There we go. Australian region and New Zealand. Now, this is really interesting because it's been New Zealand that has been at the forefront of the easing process in that part of the world, and the RBA have pretty much just sat on their hands. Interestingly enough, when we came into this process, the RBA pretty much said, why do we need to raise rates to the same degree as everyone else? The tightening that's underway at the Federal Reserve will essentially do the job for us in terms of controlling inflation, and we don't need to necessarily hurt our economy to the same degree. Well, on the way down, we've seen other central banks cutting interest rates in a dramatic fashion. The Australian inflation picture has remained an issue. And because their interest rates are relatively low compared to some of the peaks of these other central banks, they've been happy to sit there and do very little in the same way as they did on the way up, right? They took a more patient approach. This week is a really interesting one because we've got the RBA expected to cut rates for the first time of this cycle with the 25 basis point cut overnight coming into Tuesday. We've then got the RBNZ also expected to cut rates. This time around, expected to cut it down by 50 basis points. So this is a week that's likely to see really significant volatility for both of these regions. You've also got the Australian wage numbers coming out on Wednesday. You've got the jobs report coming out of Australia on Thursday. Then you've got those PMI numbers coming in late night on Thursday, leading into Friday. So it's a massive week, really. You can see in terms of Australia, we have seen them gradually bringing inflation under control. Wage growth also sort of turning over. That's why it's interesting to see those wage numbers coming out. Remember, like was pointed to here, we've got this wage price index quarterly and year on year. And so when we're looking at this, you can see that year on year wage price index is rolling over. But we're sort of flatlining recently in terms of the quarterly wage price index. So keep an eye out for that as well. If we see that moving towards the downside in a meaningful manner, let's see exactly what markets are expecting. Markets are expecting that. So 0.8 down to 0.4, and then a move down to 3.3 on the year on year. So, that leads inflation. That is one of the key inputs for inflation. It points towards the possibility of further disinflation in Australia and further rate cuts down the line. In terms of market expectations, like we said, RBA expected to cut by 25 basis points, 86% chance of that. And then you look beyond that towards the rest of the year, and you're looking at essentially another 2 rate cuts on top of that. So markets really do expect that this is going to be the beginning of a phase of easing. But we've also got the RBNZ, where it's 100% chance of a rate cut, but 72% chance of a 50 basis point cut, an oversized cut from the RBNZ. And looking further out, where do we expect to be by the end of the year? Well, the November 2025 meeting has I would say, outside chance of getting down to 3%, but the base case scenario is down to 3.25. So another 2 cuts on top of this. So I guess the interesting thing is, how are people going to take this? Because we're looking at a pair of central banks that are likely to be cutting, one more than the other. But then one is instigating a new easing process, and the other one's just following on from what they have been doing previously, bearing in mind that we've got the RBNZ that are actually now ahead of the RBA in terms of that move lower in terms of interest rates. So arguably they're closer to the end than the RBA are. So that's another argument why people might look at it from a different perspective. I just wanted to bring up this daily time frame because what we have seen is this strengthening in terms of the Australian dollar against the New Zealand dollar, which is something you would expect when you've got one easing rapidly and one keeping interest rates steady. And you can see we've got this sort of long-standing trend in play during 2024. Nonetheless, we're seeing this pullback coming into play, and certainly there is a potential kickback that comes if we see the RBA cutting interest rates and laying out a more dovish tone, because we're used to it from the RBNZ. The RBA is going to be something new and something for markets to respond to. So for the time being, we're starting to roll over. Let's just get this on a full screen. So we're starting to roll over here in terms of the Aussie dollar against the New Zealand dollar. Certainly, we have a long-standing sort of bullish trend in play. So let's see if we can sort of tie that up with a ascending trend line. So you've got this ascending trend line in here. But I think there's a good chance we do see further downside over the near term. Certainly, there's going to be plenty of volatility over the week ahead. But certainly, as we've rolled over here, taken ourselves down through what looks like a sort of head and shoulders neckline, there is a possibility that as we lead into these announcements and trade around these announcements, we could see some weakness for the Australian dollar coming into play against the New Zealand dollar. So a real interesting one to follow. It's also worthwhile bearing in mind that as we see people growing increasingly confident around China and the potential resurgence of the Chinese economic story, we saw higher inflation recently. We've seen people more confident with the DeepSeek news. That should benefit both countries. But whilst the New Zealand economy is more reliant on agricultural goods, dairy goods, things like that, I would say that the Australian dollar, the Australian economy is more aligned with the Chinese economy from the perspective of they need significant development and spending and economic growth from China for them to be able to export their commodities. And therefore, that provides the basis for strength for the Australian dollar. So near term, it does look like we've potentially reached a short-term top and we could roll over further. And certainly if we do see further downside for the Australian, if we see the RBA laying out the pathway for more downside for rates, that could provide further weakness for the Aussie dollar. But like I said, that China resurgence story does ultimately provide significant upside for the Australian dollar if that's how it plays out going forward. And finally, let's look at the Canadian region. Now, Canada has seen significant downside in terms of inflation already, right? So 1.8 in terms of headline, core at 1.8, that's expected to drop down to 1.7. The inflation on a monthly basis, 0.2, minus 0.1 expected. PPIs, 4.1 expected to rise on that front. That's an interesting one. Retail sales, minus 0.7 expected to rise up to 1%. That's excluding autos. The month-on-month prelim expected to come in at minus 0.3. So weakness in terms of retail sales, and that's highlighted by the year-on-year retail sales of 0.5 expected. There are big question marks around Canada because, of course, this trade relation with the US coming under fire. Donald Trump once again reiterating that we don't need Canada, we don't need their goods, they should just become a 51st state. Things along the line of that. Canada needs to up their spending. We're not going to protect them anymore from a military perspective. So they're coming into fire line. But certainly there was that agreement that pushed it back, the tariffs around fentanyl, pushed it back by a month. And so when you see any of those fears allayed, it provides the potential for strength for the Canadian dollar. But then as we get closer to that deadline, and if we continue to see him laying out the possibility of significant tariffs, then it points towards a possibility of weakness for the Canadian dollar. And in no small part, that's also driven by the weakness that we've seen in terms of inflation. 1.83, that's well within that 1 to 3% target range for the Bank of Canada. And you can see the 7-month annualized. So once again, I'll try and sort of wrap up exactly where things will be once we see a hefty chunk of inflation taken out. And once again, it's February, March, April, May. So once that's stripped out, where will we be? Well, we could see inflation below zero at that point in time. So certainly that is grounds for further easing when it comes to the Bank of Canada. And, when we're looking at the likes of dollar CAD, we'll be able to see that, yes, we've seen some reaction thus far to that announcement that we were going to see the tariffs delayed from Donald Trump. You can see here that pop here, dollar CAD. We swiftly reversed, come back into support here, back down at 1428. And now we've broken through that. That provides the basis for further Canadian dollar strength and further US dollar weakness. Now, it's very interesting to note that we saw strong inflation data out of both CPI and PPI from the American region over the course of the last week. And we've seen the US dollar weaken. Well, in part, that's down to the fact that the tariffs, the reciprocal tariffs, have been sort of delayed somewhat. They're not going to be immediately implemented. That gives time for potential agreements to come into play. But also this feeds into the narrative, and I've talked about it week on week, that Donald Trump, whilst he says he's pro-dollar from the perspective of not wanting people to trade their goods, their commodities in anything but the dollar. It's not to say he needs the US dollar to strengthen over the course of his tenure. That's not what happened when he was in power previously. And there's a good chance that if he wants to strengthen their trade relationships and their exports and grow their exports, he would need a weak dollar for that to happen. So at the moment, we have the basis for potential further downside to come into play. But like I said, if we see further weakness in terms of Canadian inflation, if we see the resurgence in terms of talks of major tariffs being placed on Canada, then there's a possibility of dollar CAD coming up once again. But bear in mind, we've got a bullish trend in play here. We're now set within a bearish phase within that trend. We don't necessarily know exactly how deep this pullback's going to go. Let's look at the fib levels and see exactly where the sort of key levels are. So thus far, we've moved beyond the 38.2. The next level is the 50% retracement at 141, then 1394, which is 61.8, and 137, I think that is, which is 76.4. Ultimately, I think it's a case of being nimble on this. You're looking at a market that is likely to be relatively volatile as we react to news quite heavily. Like I said, that CPI announcement is going to be key as well. But just keep following these near-term, intraday swing highs. We continue to create these lower highs, then that's key. Once we start to break out from that, then you start to look like we could see the bullish momentum coming back into play once again. And that ultimately is the long-standing trend that we have got in play here for dollar CAD. But a counter trend reversal is currently in the footing. Bear in mind also the Canadian dollar highly correlated to the likes of WTI's US crude. So oil prices, if we see a pop in terms of oil price, that should be beneficial for the Canadian dollar. It's not necessarily something that's been playing out too much thus far, but just another thing to consider as you go forward. I hope this has been useful. Plenty to sink our teeth into for the week ahead. Make sure to check out my earnings video as well, as I touch on the likes of Walmart, Alibaba, and Booking Holdings. Another busy week, and it's always interesting within markets at the moment, in particular when Donald Trump's around. He keeps us on our toes. Have a good weekend. Have a good week. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Make sure to like and subscribe and follow for more content like this.